So, Mike, talk a little bit about the deal that you guys got going on.
The one in Tulsa?
Yeah.
Okay, great. Thanks for asking. It's a 277 unit value add C-class workforce housing apartment complex. And it's actually 5 properties.
Okay. And how are you guys financing it?
Yeah, we are assuming 5 Freddie small balance loans. And today, the interest rate on those is at 3.6%. And it's fixed interest. And it's we have 8 years left on it. So part of our exit plan, and you know, Ryan, I'm real big about exit plan. Part of our exit plan is that we'll get out of this deal in about 4.5 years because we know somebody else will assume that mortgage. So,
talk a little bit about being able to acquire that low interest rate debt, especially in an environment like right now.
Yeah,
where the debt is half the cost of it.
Right, because the T2, the 2-year Treasury just went to 6% yesterday. So the way we can acquire that debt today is because when you do a commercial mortgage, there is an assumption clause in those mortgages that allows you or the new buyer to assume the mortgage, to assume the rate and the balance on the debt and the difference between the balance on the debt. And I'll tell you something funny about this too is this particular owner of this property doesn't do a really good job, and Freddie is glad that a new operator's coming in with better experience and better knowledge to run the deal. So they're more than willing to go ahead and make that assumption go through.
It sounds like they're just as involved as you guys in the process, right? Whoever has the note.
Yeah, the lender's definitely involved for sure. Yeah. So.
And you guys are still raising capital? Are you taking IRA money? Are you taking cash? Or are you guys?
We're still raising capital, whether it's IRA money or somebody has cash on the sidelines. There's big tax benefits and depreciation benefits. Matter of fact, Ryan, why don't you say a few things about tax benefits in these syndication offerings?
Yeah, so as a syndication, as a passive investor, you can really offset your passive rental income with passive losses. So last year, I think I probably made $150,000 in rental income. I didn't pay anything in taxes because I had enough losses coming from my real estate portfolio. So if you're somebody who already has a portfolio of properties and you have a lot of income coming from them, you can invest in something like a syndication. And even though you're not doing any of the work, you can still get all the losses to help offset your income.
Right. So, and you know what's nice about depreciation, and correct me if I'm wrong, is that it's dollar for dollar. So what that means is if you make $100,000 and you get $20,000 worth of depreciation, instead of being taxed on $100,000, now you're only taxed on $80,000 of income. So it really helps you save money. So if you're looking for short-term cash flow, and this is the thing that when we put these together, we really like to provide for people, is the short-term cash flow and then long-term wealth. So if I can't cover both, that's why I invest in the markets I invest in, because I'm able to provide that short-term cash flow along with long-term wealth.
That's a strategy, huh?
That's a strategy.
Cool. Yeah, I'll send it to you.